All right, hello everyone. This is Shane with Trade ATS. Before we get started, kind of same deal as usual. Go ahead and type a Y if you can hear me. Just a quick little sound check before we get into it. All right, looks like we're good to go. So anyways, just want to welcome everyone to this week's webinar. So for those of you that have been on, you know that we like to go through and look at maybe 5 or 6 pairs or whatever it ends up being, and looking at the different time frames of all of it. But this week we want to just focus mainly from the get-go on the pairs that you guys want. So if I could have everyone just go ahead, type in the pair that they're looking at. We'll try and get to as many as we can, but we want to kind of kick things off with that. And you also get kind of a snap reference of it. So we'll just go through and kind of take a look and try and form an opinion, a little bit sooner than later on it. 2 pairs that we are definitely going to look at is probably gold, that and then we'll try and touch on the pound pairs, or at least one of them, just because there's been a lot of action in that. So one little reminder, if you have any technical issues, try to send those over to support at Trade ATS with a screenshot of what's going on, and we'll get that taken care of. But otherwise, we'll go ahead and jump into the webinar. Wade, take it away.
All right, thank you, Shane. I want to welcome everyone to this week's webinar. Apologize I couldn't be on last week. I wasn't feeling well, so again, appreciate Shane was holding it down so we can keep on schedule, but I'm feeling better and back at it. So what I wanted to go over today, we're going to take a look at some pairs. So like Shane mentioned, if you guys have just, we'll try to get in a handful. Usually those get a little long-winded, so I'll try to get in a handful, but what I wanted to talk to you about today, let me see. Actually, I want to address one thing real quick. That was a question that Shane said that we've been getting through the support. He so you guys know, he heads up the support, department and runs that whole thing. So he kind of clues me in on what's coming through there a lot of times. But one thing he said, which is something I don't want to spend a lot of time on this, but just real fast. I want to address the boxes. Sometimes there will be situations where candles they seem like they're outside of boxes, and I'm struggling to find one right now. But anyway, what I wanted to mention about the boxes, so you guys know, before we did the last 2.0 update, we had version 1.3, and those boxes, the boxes appeared, and then that's how they stayed all the time on the version 1.3. And this was the old one for those of you guys that have been with us for a long time that remember the blue and yellow candle version. The version 2.0 now has the dynamic boxes, which is a lot better. But what ends up happening is that these boxes will appear, but then as the market consolidates and contracts further, they actually resize and tighten up. Now they're not, in a sense, I guess you could say, okay, the box is changing, but what it's doing is actually snugging up to the price action as it develops. It'd be a situation like this box right here. This box did resize. It at first was covering from this high to this low, and then it resized. And so what it's doing is it's showing you a tighter breakout area for the contraction phase of the market. So anyway, that was a question he said. With some people were wondering, why the boxes change or what happens at that time. It's not going to happen on every box because the algorithm is very specific. But if you're wondering why that happens, that's what it is. It's actually shrinking to the market when necessary, when the algorithm says, yeah, it needs to do it. And it's just to get it more accurate and more tight in that spot. So we get an earlier signal when we leave that contraction or when we go into the expansion phase. So anyway, I just want to touch on that. I don't want to spend a whole lot of time, but if you guys are wondering what the deal is with that, that's what the deal is. It's actually a really cool feature. Anyway, yeah, it's just to make it more accurate and more of a leading indicator. Okay, so that I just want to touch on that. One thing that we have gotten questions on, and I've neglected to talk about a lot, that I want to talk about today is the IREG indicator. You guys will notice that when you load up the templates, you'll have one that says with IREG. And what the IREG is, let me pull it over here. Here it is. Okay. So what the IREG is, if you just throw it on here, it's this curved channel type thing. And you guys, a lot of guys are saying, what is this? How do I use it? Is it beneficial? So I want to preface this conversation with a few things. Number one, the IREG is not our indicator. We did not at Trade ATS, we did not invent this. Okay. It's something that is out there. You guys notice it takes no license key. We don't put a license key on it because we do not own it. It's not our proprietary software. Where did it come from? The original code, a little history lesson, came from a trader out of Morocco. I don't want to butcher his last name, but I believe it's Mustafa Belhayate. If I say that right, I probably messed up the last name. But anyway, he came up with the original code of this, and the system. There's a whole like this is like a dumbed down version of what he came out with. But that he's the one that kind of invented this predictive curve feature of this. So that's where it originated from, as far as I know. I don't know, that 100%. It could have been someone before him, but if you read the farthest I've researched back, it comes to him, and I'm just gonna leave it there. So where this came from with us is that the trading group that we used to be part of, or that we used to have a long time ago, this was one of the things that we used years ago. And the traders that started with me in Trade ATS, when FXCM went out of business in the US, that was kind of the end of that old group, because all the software and everything that we were using was dependent on FXCM's trading station platform. And I know that they still have that platform in other parts of the world, but you got to remember our trading group was a US based group. So that was the broker we used. Everything was tied to that. So it kind of put a stop to that whole thing. And that's a little bit after that. That's why I got a fire under my butt and got everything made for MetaTrader. So we would never have that problem again, and did some upgrades to software and all that along the way. But anyway, we use that, the IREG, which we used to call it the COG back then, years ago, center of gravity was what that standard for, as a part of the system. Sorry, we got some comments coming in here. So that's where it came from, and I kept it in here because we had a lot of people that had started with Trade ATS that came over from the other group, and we're just used to looking at it, and they're used to knowing how to weight it, and so I just put it in there as just a little helper, and that's why there wasn't a whole lot of formal training or anything on it, because I threw it in there for them just so they had something familiar to put on there, and that was it. It was just kind of part of the package. But since then, obviously, the program's grown. We have a lot more people than what we started with, and people are wondering, okay, what is this thing? Is it useful? What do I do with it? So that's really what I want to get into, is the meat and potatoes of that. Now I'm going to start off by one thing that this indicator does repaint. That curve, if you run it on the simulator, not the simulator, the back tester, you'll see that curve. It will curve up, it'll curve down, it'll go flat, this predictive quality when you have it like this. And you could change this, like right here, it's the degree right here. Like I could set it to 5 like this, and then it'll make the curve different. It makes it more aggressive. You could even set it to 8 and it'll make it super aggressive. So you can change this, and that's a problem with the curve predictor of this indicator, is you can make it conform to whatever looks good. You can change the period, you can change it, and that's what I don't like about it. And that's why it's not a part, it's not I don't say it's a part of ATS. Well, also because we didn't invent it, but it's just this is something outside of what we do as the base chart mapping system. So Anyway, you could see that you could change it around, and you could change the width of it. You could go to a 3.0 if you want a wider, like the same thing as like a Bollinger Band. You could change the width. You could change as many periods as it reads. We could change this to 50. We could get this thing looking really weird. You know, it's like, okay, you know, so now that's what it does, you know, and because of the repainting, there are some certain settings and things, and believe me, we spent a lot of time and a lot of money trying to figure out how we can make those curves work and reworking the code. Um, you know, we had, well, let's just put it this way. We had a bot that we worked on with another partner. We probably dropped 30,000 bucks into this bot to try to get a significant signal from this indicator for to help enter in trend. That's when we were messing with more automated stuff. It's a different story for a different day. But anyway, so I've ran the distance with this thing, and let me tell you, there is one thing that I think it could help with. And that's why it's still here. And this is the only way, if I would ever throw it on a chart, this is how I would do it. Number one, this curve, the degree predictor, I set this thing to 1, which is basically no curve. Now it's just a straight up regression channel. Okay, no predictive curve, because that could throw you off. It can make you feel like the market's turning when it's actually not. So so that's what you're going to do there. This is, and like I said, this is just my opinion. You can use it how you want, but this is you know, this is the training you're going to get on it. This is it right here. Okay, so one thing that I'll do is that, because in ATS, obviously we have to navigate these rotations, right? So we have situations where the candles are rotating, especially on our higher time frame, and we're trying to work the trend and stay in that trend. So here's where it could be useful. If you look at most of these turns that we're looking at for a reversal, happen within 2 candles, you know, 2-3 candles. So, and there's no magic setting to this, I'll tell you right now. But what you could do if you do want to use it and you want to explore with it and see if it's useful to you, is that you can take whatever your higher time frame is, your directional bias time frame, take it and then take 2 candles. So in this instance, we have the daily chart right here, right? We have a daily chart and we have a 1 hour. Let's say we're trading a 1 hour in the daily. How many 1 hour candles does it take to make a daily? It takes 24, right? It's 24 hours in a day, right? So what's 24 times 2? It's 48. And so that'll accommodate 2 daily candles. So if I'm trying to navigate a turn like this, or the turn we're in right now, what you could do is you make it 1. So you make it rigid. That's the first thing. This thing, you could mess with this. I don't know. You could probably just leave it at a 2.0 and be done with it. But right here, this is where it could get a little bit interesting and helpful, is the bars that it actually calculates. Right here, if we have a 24-hour day and we're looking to navigate the daily, you know, in those rotations and see something significant, what you could do is type this in. So you want an average, a regression average over 2 days. So we put 48 periods in here, right? Okay, now I know that I'm tracking 2 days of time. So where this could be helpful is in situations like this right here, like we were climbing out of the bottom of this. This is kind of trading against our average price up here, but in this situation, this regression channel would actually come through and adjust and start sloping upward. And then when you get a situation like this, like you pull back below average price and then whip back through, you would already have that regression channel pointing upward, and it would coincide with the green candle or the rotation on the daily. Same thing right here. As this is going down short, you have that regression channel sloped up, and then basically what you could end up doing, and we have the liquidity lines to show us where to exit, but like I said, if you find it helpful, if it gives you a little more confidence in the trend, you could enter the same way we enter under expansion into a green candle, and then take it across we used to call it across the band. You trade across the band. You're going back some old terminology there. But anyway, that's what you could do with it. And in that situation, you know, it would be sloped up. You're going from the bottom of the band, taking it up to the top of the band, but obviously you have liquidity lines and things to work with as well. And you want to use those first. That's the number one, because that's the real, you know, architecture of the market is the ATS lines, the expansion lines, liquidity lines, boxes. That's your base three components. But anyway, if you want to, if you find that it's helpful, you know, in this situation like this, we're pulling in red. We pull up. You can see we held structure up here at this expansion line. It's top of the band, and now it's fallen back. Now, if you were in, for whatever reason, if you were in a short right now, you know, you'd be working back towards this line and then down across the band. But you can see it just generally shows the trend. So that's how I would suggest that you use it. Let me see here. So going back, the biggest thing, the biggest takeaway that you should get from this is understanding that the predictive quality of the curve, having it like this is showing the slope down. Let's see what happens when I change it to a 5. Okay, it's still sloping down, which is good, but I'll tell you right now, this thing, it'll feel like, oh, it's so awesome, it's predictive, but overall it randomizes. I'm telling you right now, we back tested it. I wouldn't get caught up in that. Again, you guys could do whatever you want, but I would keep it at the flat setting. And then the periods, just set it to a period that's a multiple of your higher time frame, because then you're getting insight into the actual turn. You see that it's sloping down. Well, we see that the color of the candle is turning red on the daily. That's somewhat useful. So let me change the time frame. So if you're trading like the monthly as your higher time frame, if you're doing longer term trades, okay, we got a green monthly, and then this will change to the daily. So you'd be trading the daily into the monthly. And then for 2 months, we'll just go off of 31 days per month. It doesn't have to be exact, just close. So that would be 62 periods, right? So instead of this being 48, we want to navigate 2 monthly candles. We're going to change that to 62. Okay, now it's flat. You can see those 3 lines completely flat, and they're kind of, you know, here, one thing with this, you can change the colors because the default colors are kind of dumb. You could change to something that's like just not our colors for the ATS. Change like magenta or something here. And then if you want to make it thicker, you can do that too. Okay, now we can see a little better. Okay, so you see it's straight up flat right now. And that's representative of what's happening on the monthly. You can see we're starting to turn, but we got a wicked out, for lack of a better term, doji candle right there. And you know, it's going flat. So that's representative of what's happening in this situation right here, right? So anyway, it could be useful for that. We'll switch back over. Let me try the 4 hour into the 5 now. So if you're trading the 4 hour, and then we'll stick this on a 5 minute. Okay, what would be the period? So right now we're looking to navigate 2 4 hours, which would be 96 period of 5, right? Multiple of 5 into 2 candles. I think that's right. So we'd change this to 96, and that would be representative of 2 4 hour candles. There you go. There's your slope. Make sure, yeah, I got that right. Okay. Yep, so there's your slope. As you can see, the 4 hours pulling around. So it's an average of this candle and this candle right here. We're actually going, this candle is relatively new. So those 2 candles right there, and we can see that starting to happen. So, you know, like I said, that can become useful for this indicator. Now, here's the disclaimer. If you want to play with this and you find it useful, by all means use it. If you don't, if you feel like it's confusing you, just delete it, because you do not need this indicator to use ATS. But if you like seeing you like seeing that trend, that kind of, you know, floating trend line in that channel, and it gives you more confidence in the slope of the trend, then, you know, play with it and see how you feel about it. But anyway, that's the lesson today. That's how I would suggest using it. And I'll probably take this lesson and stick it in the online course, and we'll cut it up just because there's not a whole lot here, but you know, I feel like this would probably be good to throw on the online course, and you know, then you guys will have something of what this thing means. So let me catch up on some of your guys' questions. So I'm going to see if there's any questions about the IREG, and I'll address those, and then we'll get into a couple of markets and do some top-down analysis on that. Let me see here. Okay, one question says mine is not curved but straight lines. Is that right? From Bill. The way that it sets when we send the template, I automatically program the template to be to have the 1 setting on the degree turn, and that's what it loads up. So if you guys save a template, it'll automatically just save the settings of the indicators that way. But you'll notice you'll if you click on the indicator, you could either go to your indicators list or you could just double click on the line. Then you'll be able to change all that stuff to whatever you want. And like I said, the whole point of this lesson is to give you suggestions of how to use it. In the 2 important numbers is this one and this one, and then I would just normally just leave this at like a 2.0. Seems to be decent enough for what we're doing. So those 2 numbers, you could don't set this one to 1, and this one is just a multiple of your higher time frame, whatever you're trying to navigate on the higher time frame. Okay. Question, could this be used as useful confirmation? Again, yeah, it could be useful, just like I said. You see the rotation. It helps you. The biggest thing is if you have it set as a multiple of your directional bias, it could give you a little bit added feeling of security. To show you the slope of the trend and make you feel a little more confident to get in on the trend. But like I said, if you find that it's not doing that, then I would stick to what you don't want to do is you don't want to get confused looking at this as the IREG as an indicator all by itself and forget about the architecture of the market. The architecture of the market is the most important part of everything. So if you find that it's your analysis is you're putting more weight on IREG than you're putting on chart map, you probably want to delete it because it's going to add extra confusion instead of extra confirmation. Okay, here's a question. This is a good one. How did you calculate the 95% winning Forex trading formula that is advertised? The way that we came up with 95% is just the fact that 95% lose money over time, and we're doing the opposite as a methodology. Is it always going to be 95%? Well, maybe stretched over a huge amount of trades, but and this is a good lesson right here. What we're talking about is that when you're doing the way that we talk about on the basic strategy, it's what's categorized as a winning trade. Okay, a winning trade is something that is going to come back to our center of gravity, which is our average price in trend. So let me show you a situation here. Okay, so right now, let's see. We'll take, because it's just in the expansion phase over here. Let me see if we had this. Okay, so here we had this pop right here on the 4-hour chart. You're above expansion, and this is what we talk about on the master pattern video and everything. You have a situation where the market expands, you have a white expansion line to work with, price settles. In this case, sometimes it'll settle, sometimes it breaks out. Either way, it's above or below. That's where it starts. These candles are clearly above, we're trending up. You had a pull down right here. We had another leg up on the 4-hour. So we'll take this section right here. This is clearly above. You're getting a rotation above, long, everything's long. In this situation, what we talk about, 95%, 90, 95%, we talk about that when we deviate below, as long as you're above expansion here and you have green candles going above trending, when you get below average price, that we're going to come below and we're going to go right back to this level. Same thing right here. You have a reference point, you go below, we're coming right back to this level. And that's what we talk about is a very high win rate. Now, do we know that if it's going to go above and hold like we talk? No, we don't know what the market's going to do. All we can do is manage our trades in a smart way and enter the market in a smart way. We don't move the market. We have to conform to it. But What is considered a winning trade is where you're below expansion, right here. You have that set up, you get in somewhere and you come back at least to this level. That's it. The system's designed to get you in the money so that you have a strong position rather than a weak position in trend. And then it buys you choices. Do I ride the trade? Or do I cut it? And even in situations where if you're managing your higher time frame right, and you're doing what we say on there, you should at least, even in trends that don't end up panning out, you should at least get back. Let's say, for instance, this didn't happen. Let's say, for instance, it came back, it held under here, it came up to the line, and then it started backing off. It started falling away. That would be a clue that the trend is possibly running out of gas, but it still puts you into the money and gave you choices. So that's what we're talking about. It's from here to here. That's it. And then the progression that we're looking for bigger winning trades is to see what happens when they get to this white line. This is just the entry. You'd enter, even if you want to wait to the rotation, enter, see what happens as it comes back up. Right here, you're in the money from the turn to here. Now you just got to see what happens with the trend. In this case, what we're looking for is we're looking to get through expansion. Now you're in the money on that trade, and now it's how long can you stay in, and that's where we have the past liquidity lines. There wasn't anything up here to work with in this particular move, but that's what you're looking to get to, is your entry to expansion and then beyond, whatever the market's willing to give. Same thing right here. You're below expansion. You held on these two levels of structure right here. Previous rotation back to expansion because the 4 hours long, through expansion right here. Boom. This is the gravy right here. So it's the same thing over and over and over again. And the trick with the strategy is being confident in your higher time frame. That's everything. It starts on this chart. If you don't feel good about this chart, forget about your lower time frame. If you're in a situation, this chart, I mean, this thing, pound USDs on the 4 hour time frame is really flowing right now. So there's a lot of good opportunity in this chart. But that's really where it's going to start, is understanding the 4 hour. Like if you look at a situation like this, we're pulling short, it comes up, it's holding, we're settled, right? It's settled right there. We got a red candle. This is setting up for, probably not today, but we'll see what happens. It might kind of go sideways right here, and then by tomorrow's session kick in, and we'll head short, maybe back down to this level, this expansion level right here. But this is a great situation right here. We've expanded. We're out of the contraction box. We went in expansion. We're holding below. And now you're getting that signal. Okay, if this holds red, you're probably going to get a decent sized run. And then those situations, like I'm telling you, right here, are going to start playing out. And that's essentially what we're looking for. So let me catch up here on some more comments. Hang on, guys, real quick. Okay, good question from Fernando. Expanding on this, have you found on the supporting time frame bars that are wiki or with bodies smaller than say 50% of the range, the probability of success is reduced? Here's what's going to make it successful. If you're trading higher time frames, you kind of just need to go with the higher time frame. Meaning, like if you're trading the daily into the monthly, you'll notice that the volume distribution over a daily chart. Well, let me show you. Like if I change this to a daily, and let me get rid of the IREG here, and then if you throw the volume on here, you'll notice that it's a pretty even distribution of volume for the most part, especially if you change that to like the weekly. It's pretty even. I mean, well, you get some bigger news that comes in, but overall, you're not looking for the cycles of volume. Whereas within the New York session and the London session, you'll get a big volume curve up on the 1 hour, and then it'll die down. And then this is more on the majors is what I'm talking about. So let's switch over to a 1 hour. So there's your volume curve distribution, right? This is when the sessions go low. This is when the sessions come in. This is when the banks are making their moves. And then same thing. So you can see that. You don't see that on the higher time frames. It's just more just generalized, right? So when you're looking for winning trades, one of the biggest things that you want to avoid is you really want to avoid this part of the day right here, because typically you're going to have situations like this. So you know, you got to be careful with that. If you're trading on the 1 hour, you know, 1 hour or below, you'll have these volume distributions like this. So what you want to do if you're trading like the 5 or the 15 minute as your entry, you want to look for entries. Number one, you want to look for your higher time frame to be trending, because if it's trending, it's probably the trend is probably already set up from the day or a day or two before, or maybe the previous week. It's going to be continuing in that trend. But if the moves you're going to pay, it's going to be in the highest volume curve of the day typically. So you want to look for where does that curve typically happen, and where could I enter, you know, at least coming into that. Like this one right here on the 1 hour was coming into the volume curve right here, and you can see we clearly had the uptrend. And then we'll change this back, because you'd want to trade the 1 hour usually into the day or into the week if you're building a longer term position. But right here, this one was coming in, it was below, that's our setup. You got green daily candles going long. This one is, you can get away with this, but you are trading against average price. So you got to keep in mind that you could be headed for a turn. So you got to manage your money, you know, accordingly to that risk. But same thing, we got a green trend on the daily. You're below, you come into the volume curve, and then you can see that's where the actual move happens. Same thing right here. You get that kind of manipulative move short against that direction coming out of that turn, and then we actually have the actual move in that volume curve. So if we translate that down to a 4 hour, and then let's make this a 5 minute. Okay, so there's your daily volume curve right there coming up through. So you can see that it's starting to die off a little bit. Doesn't mean that it still can't push, but overall, you know, you want to keep these things in trend. So going back to the original question, if it's wiki, what you want to be careful of is if you want to spot a clearly defined trend on the higher time frame, and you want to try to keep your entries in the volume curve when you're trading on a 5 and a 15 all the way up to about an hour. You know, if you're trading the 1 hour, you're basically trying to catch the volume curve as your trade, essentially. But these ones, you want to keep these in the volume curve, because you know that there's enough volume in the market to actually take you somewhere. What you don't want to get caught up with on your higher time frame is if you're trading out of session, like especially if you're trading US based pairs like pound USD, dollar CAD, euro dollar, those going into the Asian sessions, Australian sessions are going to be very difficult to trade. And I know a lot of you guys, especially here in the States, because our time zones aren't super great for Forex, especially us in California. You know, it's difficult to trade London session. You got to be up, for us, we got to be up around midnight if we're going to do that. So anyway, you could get into situations where you feel like I got to make something happen. Like I get home from work and I can only trade in the Asian, so I just got to make something happen. If that's your situation, you may want to switch to higher time frames, because in those lower volume areas, you get those wiki candles, and you get situations where the market, you may have a perfect entry, you may be doing everything right technically, but the fact is the market has no gasoline. It has no gasoline, though the fire's not burning. It has a high probability of not going anywhere. So keeping your trades in the volume curve is going to increase the probability. Understanding the trend on the higher time frame is going to increase the probability. Remember, if the higher time frame isn't doing something that makes sense to you, stay away until it is. So that's gonna increase your probabilities. And if you find that the lower time frames are too difficult, move up into the 1 hour into the daily, 1 hour into the weekly, 4 hour into the weekly, daily into the monthly. Find what suits you, because you'll do just as good in something that you can effectively manage. That's one of the biggest things that we see when I used to do coaching calls, and one of the first questions I would ask is, do you have a job? Or what's your work schedule? And they would say they do the, okay, I do this, I work during this time. And so for instance, let's say they live in, Midwest United States or somewhere here. I'd ask, do you have a job? They say, yeah, I work 9 to 5. Okay, well, you got to be prepared for that job. You're not full-time trading yet. Maybe you are, but if you're still trying to fit in a job into your trading schedule, then you have a responsibility to be at your job. You got to pay your bills and do everything in the meantime. What a big mistake people make is that they try to trade and manage the job all at once and they try to trade on lower time frames. That's the second question I ask. What time frames? What's your supporting? What's your entry time frame? And say, oh, well, I'm trading the 15 and the 4. I'm going to tell you right now, if you're trying to go to a job and trying to work, you cannot effectively manage a 15-minute chart. You just can't do it. If you're trying to look at it, I mean, unless you have a job where it takes very little attention and you have a screen in front of you, like in an office all the time, and they don't care if you're sitting there trading, then maybe you can make that work. But as a rule of thumb, generally, you can't effectively trade a 5 or a 15-minute chart when you have your head somewhere else. It's hard enough to be on top of it and make the split second decisions you need to make when all you're doing is focusing on trading. It's hard enough then. Don't give yourself a further penalty by trying to put it all into your work schedule. That's going to be, it's going to significantly decrease your overall chances of being up. In that case, doesn't mean you can't trade. What you need to do and what you'll find is much, much less stressful. It's a little slower, but working on 1-hour charts, 4-hour charts, or daily charts for your entry. If you have a reasonably flexible job, you can get away with working on a 1-hour or 4-hour chart. You would need to check those charts once every hour or once every 4 hours. Just think for whatever your entry time frame is, if it's a 5-minute, you need to be able to look at that chart every 5 minutes at least. If not, just stare at it the entire time. If it's a 15-minute chart, you need to be able to look at it at least once every 15 minutes to make sure you can take a temperature of the move that you're trying to work or the opportunity. If you're trading 1 hour, again, you can glance at the chart every hour, maybe take a look at your phone because you know where the lines are from, when you looked at it at home. So that it's still a little fast, but you can manage. And then it goes up from there. But I find that I had one guy in Canada that started with us, and he was a doctor. I think I can't remember if it was a dental practice or he was an MD. But anyway, he was a doctor and he had a practice, but he would meet with patients and he had his screens up in his office and he was able to check in and look at things, and he found that it worked really well trading the 4-hour time frame. It worked well with his schedule. He could get in, he can look for opportunities, and if he didn't feel like it was quite right, he could go see a few more patients, come back in, see how he feels about it. And it was perfect. He was actually able to effectively trade those time frames because it worked well with his schedule. So you guys have to figure out something that works for you and that you can be effective at. And the very least, if you want to be an active trader, I feel like it's kind of like, using the daily as your entry time frames, kind of the highest. And if you're going to a weekly to a monthly, then you're kind of more of a, maybe everybody's a trader, but you're kind of just, you're looking for much, much longer term moves, which is fine. But that's, you're just kind of just waiting for fundamental trends to change and things like that. So usually probably the daily into the monthly is kind of the highest that most of our guys are going to go. And you could do real well with those time frames as long as you're patient and you wait for the opportunities. In that case, you could probably look at 5 or 6 different pairs if you're waiting for something, on that big of a time frame. And the cool thing with trading higher time frames is that those moves that, like if you're trading a 5-minute or a 15-minute, those moves that, like, let's say you're waiting for it and the trend, and then all of a sudden it just snaps and it goes and you miss the entry and you're like, oh man, or you hesitate and it just goes so fast. Well, the cool thing with trading the higher time frames is that you're typically already in those moves because you're riding the overall trend. So when you wake up and it's like, oh, it snapped down 70 pips, it's like you were probably already in that because the entry opportunity was a day ago. You know what I mean? It's a different risk management situation, obviously, because when you're trading a higher time frame, you have to be willing to go a little bit more out of the money, trying to find the entry or however the market's gonna act. Um, but that's one of the cool things with higher time frames is that you end up, yeah, you get less action, but you end up getting more meat of the moves because you're just willing to be more patient with the trends than you are sometimes on a 5 and a 15 minute, which can also be a cause, can get you to overtrade in some situations. So anyway, it just depends on what works for you, but you want to definitely trade something that's works with your schedule for sure. So I know I kind of went off topic on that. Going back to the original question, if you got sideways wiki candles, like I said, if you don't feel good about the like this, if I just looked at this chart right here on a pound USD 4 hour, I almost just want to sell that. Why? Because I feel like right here, this was a clue. We held off average price, off our expansion. We expanded right here. We held. That's a great activity. I would let the activity come to me. I feel good about that. Is it for sure going to work out and go short? I don't know. But it looks good. It looks like this right here, right? It looks like this right here. I like these. I like it when it rejects average price. It feels good. So in that situation, I would almost want to just jump in on this. Like I would look at that and I would just like, okay, let's sell. So when you feel that way, now that I feel like I would want to jump in, I'm not going to just jump in. Now, because I feel that way about that, now I'm going to look for my expansion, my above expansion entry into this trend. Probably not today. If I'm trading a 5 minute, this would be a trade I would look for tomorrow or throughout this week because it's a 4 hour. If this 4 hour starts trending, that can go through a couple days if it really is a nice trend, or it could go even more than that. So it could turn into a massive trend. But that's what it doesn't start with. I'm like, oh, I'm just above. I'm looking at this trade above or below expansion. I got to get into a trade. Okay, I'm above expansion. Is the time frame? Is this color good? No, it starts here until you almost feel like you want to just sell this market. That's when, okay, now let's find the entry. Now let's find something safe to deal with, something I can manage my risk off of. That's where it starts. So higher time frame, feel good about it, almost like you just want to jump in, but don't. Then find your trades over here. Okay, so let me catch up on some comments here. Hang on real quick. Okay, quick question. What is the volume indicator? If you're looking for the volume, it's just right here on the bottom of the screen. It's default in MetaTrader. You can turn it on and off. If you right click on the chart, then you have your volume right here. So if you want to see that, like I said, it could be useful if you want to see the volume curve of the day. You'll see it goes relatively flat. Excuse me. It goes relatively flat when you're out of session, and then it picks up, and then you get that curve of volume as the banks come in, active traders come in, and then it tapers off for the day. So if you find that useful, it's pretty easy to turn on and off that way. Okay, hang on, guys. We're going to get into a couple of pairs here. Hang on. Okay, I want to ask you guys some questions. Does everybody understand what I was talking about with the IREG? You guys understand why it's here? We got some comments. People are going to say, I don't understand. Why is this repainting? They must have come in late on the webinar, but I want to make sure you guys as a group understand why it was included, what the potential usefulness is of it. I just want to make sure that no one's confused with that. If you guys could, I'm just gonna ask, if you do understand, type in a Y. If you don't, type in an N, just so I could gauge what's going on here. Because like the last thing I want to do is confuse you guys. So in the meantime, we'll see if you guys can help me out on that. Just want to make sure everyone's clear. I'm still reading for some comments here. Hang on. Okay, awesome. Looks like everyone's pretty clear on it. So like I said, just wanted to address it, and probably, I mean, at some point, you know, it might make sense just to take it out, just to eliminate the confusion. But anyway, that's, like I said, it was originally included for people that understood it, you know, and spent a lot of time with it, and it, you know, that. So anyway, I just wanted to clear that up with you guys here. Okay, so I'm going to get into a couple of pairs here. It's 10:52. We like to keep these around an hour, so I'll probably just do like 1 or 2 pairs. Let me see here. So we've been dealing with pound USD quite a bit. So I'm going to deal with, let me see here. We'll take a look at Euro Yen. If I could find it. There it is. Okay. Get rid of the volumes here. Okay. Okay, so Euro Yen, let's start with the monthly. Start with the daily over here. Okay, so monthly is starting to rotate short. We're under expansion right here, so this is a good sign. We have come down quite a bit. Also, we're holding on this previous level of structure right here. So we're kind of, if you're going to trade this, definitely want to be short with the directional bias. But you know, understand that the monthly could be reacting at this level for a little bit here. So right now, definitely no trade. You would want to wait for a new box. You'd want to wait for something to form. We're coming down to this level right here. So possibility you could get a box right here. And then if you do get a new expansion, or you will get it, if you get a box, you will get an expansion. And then you'd be working within that range. Let's say if the box appeared at this level, then your entry would be from that box expansion to this one up here. Look for an entry in here and then short it. Of course, a lot can happen in that time, just depends on how it forms. But if you're definitely going to be short on this time frame, but there's no entry right now. You'd have to just jump in, which you don't want to do. This is a weak position. If this starts going against you, it's not going to feel good at all. So weak position right there. Okay, let's switch over to the daily and the 1 hour. Okay, it's got more activity on the daily here. One thing with the daily, yeah, some good trades in here. Okay, so the last trade on the daily started back here. So while we are short, you know, we're below expansion, it's going short. Keep in mind that this has run quite a bit so far. It doesn't mean that it can't keep going, But if you haven't racked in some profits from up here, starting with the turn, here it is, we rejected average price, rotated down short, that was that settling, and came into a good criteria here. So let's see, what day was that? That was February 7th. Okay. Six, 7, okay. So basically right here. So this was the breakout short right here. That's what probably turned the candle red. You're not getting into that. You're gonna miss that. This one broke out short. You may have shorted this one. You can see we broke out short, rejected average price. This was more of a momentum trade. Could have ripped that short. You'd had to protect yourself probably right around expansion right here, but that was, again, that clue, holding below expansion. If you're trading the 1 hour, possibility there. So here's the trades. This was a little bit difficult here, but this is what we're talking about. You got red on the daily. You're above expansion, so you start getting into criteria. You probably enter somewhere in here. At this situation, you're above expansion here, but remember your ultimate downside is all the way back up to here, which we did end up testing over here. So if you entered in this area right here, we broke through. This is where you do get a clue. This is where you got to back off. In some situations, this could be a sign of a reversal. So right here, we're above expansion. We break out short, go through expansion, but then get rejected off that expansion. So in this situation, I'm going to call this a break-even situation on that trade. There's not a good way you'd be. This happens so fast. Yeah, I'd say you probably got in this neighborhood. You probably got out. You saw a profit. You're going to back out. So in this situation, I would stay away from this market. Give it time. You can see now we're starting to hold above. This could be a sign of a reversal. Okay. So you got to. I'm not saying don't trade, but be mindful. Now, what ended up happening? We're still short over here, right? We're still overall red, headed down. When we spiked up right here, you can see we're still working with the architecture of this market. We have this pullback in trend. It pops up to here on this leg. It still holds this level of structure. See how these boxes are all working together, and then it rotates. This could have been a clue right here, or it was a clue that we're holding below. You could have shorted. You're probably not going to, no one's going to sell on this line because at this point you may feel like it's a breakout. But when you see that rejection off that level and it turns short right here, that was a possible sell right there into the daily trend. So that would probably be the first decent opportunity, although it was hard to navigate. This one would take a little more experience, but as long as you're working that daily trend, you want to take the opportunities. Right here, you got through, and then boom, see how the candle got aggressive, pushed through, and now we started holding. That's a great sign. You're trying to get to that point. We're only the initial trade is from the rotation or the reaction to expansion. So it's from here to here is getting safely in the money, just from there to there. And then we got choices. This is the breakout through expansion, and now we're looking to hold. You see back here, it didn't hold. That was your clue. You had it, you had a chance, it didn't go, cut it, dead, forget it, wait for the next opportunity. Here's your next opportunity, boom, down. Here, this was make it or break it, it made it. And now you're in that, you've worked your way into that daily trend. So that was it. Now we got other situations up here, coming down above expansion. Again, this is difficult. Let's see where this stuff is in the volume curve. I know this is euro yen, so this is not gonna probably coincide too much. Yeah, see, this is a much more distributed curve than because it's not a US based pair, but you still have some volume curve to it a little bit. But okay, so above right here, back to expansion. This one, if you got in right here, that's a break even opportunity. If you wanted to get back in, you had another rotation back in trend. Remember, ultimate downside at this point, your last level of structure is clear up here. So in this situation, I mean, unless you're trading such a small lot size, you probably wouldn't want to just let the trade go against you up to here. These ones, you just want to work the rotation and work off the high. So your risk management is going to be from here to the high, because you're not going to go back to here. Forget that. So right here, this is a break even, maybe a tiny loss. right here, rotation. This one puts you in, you broke through, you held on this candle, had an opportunity to go, but it's still come back. I'm going to call this one a break even still, but you had the chance to explore the opportunity. At this point, you got to be thinking, was this the meat of the move? Possibly, but one of the things that you do gotta keep in mind though is if you're working a trend, you really want to try to work it for all it's worth. Especially if you ever hear of what people talk about, they talk about pyramiding into a trade or letting your winners finance your next trades. If you're holding a position that you got from up here, then you can work these positions based off of the profits that you made on this move right here if you're still holding. So you could pyramid in to these trades on these opportunities above expansion because we're still short on the daily. Remember, until that daily turns green and confirms long, it's all going short. We're just fishing for entry at that point. So you could pyramid in that way, and let the profits from this big move finance these other tries into trend. Now, if you haven't got this move, you want to be a little tighter on your risk. You want to be a little more careful because remember, a trade already went by and you didn't get this one. So you got to keep that in mind as you're making decisions of what you want to hang it out on and what you don't. So anyway, that's the daily into the 1 hour. Right now, nothing. The last opportunity was above expansion right here. Here's your rotation. It held. Right here, you'd be managing your risk pretty much on that rotation, probably to the active high, because again, your next level of structure is way up here. You don't want to, that's too big of a downside. So it's either needs to behave or you got to cut it. Right here, you'd be managing it. Yeah, it puts you into a sideways market, but it didn't pass the active high. And then you had your breakout short. And that was the next trade in the daily trend. Right now, no trade. If you're in a trade, it's one that you've been setting in from up here, or you could sell the breakouts on these right here, because this breakout you could short right here because you're still above this average price. So you can do that and still get away with it if you're in that trade from that point as well. So that would be what I see on that. Let's jump over to 1 hour. And now your immediate 1 hour trades. We'll go the 1 hour into the 5 minute. Okay, so 1 hour trade. The last run up was this one right here. There's not a whole lot going on this one. Let's see here. Okay, so really the opportunity I see was this first one we see. We had this first move. Well, let's see how that move looked here. Okay, so coming out of here, out of the box, this was 217,2300. Okay. 23. Okay, so that was kind of your grade A opportunity on this run right here. Coming down through here. Okay, yeah. Push down above expansion right here at the turn. And that was your first opportunity, came below, held, and started stacking white lines going short. So that was really the first one. Then we turned green on that. Okay. As we rotated red, here's where you're getting back into criteria, below expansion. First one above, right here, we had a breakout long, held this previous level of structure. That's a good clue. Short in here, probably on the rotation. Hold your risk above right here, especially if you're holding that expansion. If you see that clue, you really don't want to go much above this level. So you probably have your stop right here, enter right here. Boom. That's your next trade. And then right here, you're above expansion again. And this one didn't rotate. You can see how this is the thing too. A lot of you guys, especially that are newer, will get screenshots sent in and they'll see something that has moved and it's moving like this. You got to look at the previous trade. What was the previous trade that's already paid? Okay, it's this one right here. You see the opportunity. So you got to work kind of backwards. What's already paid? Did I get any of that? If you didn't get any of that, you need to be more careful. Okay. In a situation like this, someone who's new to the system, They would, right here, you got a new expansion line on this candle on the 5, and they would short it right here. Boom, just go short. Now, the experienced person would say, okay, I already missed this. I see this. I know I'm in criteria generally. And you would get a signal right here. The minute you got this, this would be a grade B signal on that, if you're running the ATS assistant in the 5 in the hour. This is where people get confused. They get the signal, they just short it. They just get in right there. But you have to give it time, especially as the market has come down. You want to wait for some sort of reaction. Right here, this thing came all the way back up to the previous level of structure. If you shorted it, that's why I tell you, your risk, it can go all the way, it can use the full architecture of the market and go all the way back up. It was the same situation what we were looking at on the 1 hour chart. Let's see if we can go back. Same situation right here. Technically, you're in criteria if you were doing the 1 hour into the daily, but your last level of structure is clear up here. So understand you can get a full reversal back up into that level. That's a possibility, and that's just, it is what it is. So you got to prepare for the possibilities. But in this situation, you want to wait for a little more confirmation. You didn't want to short if you were until up here. But here's the thing, at this point, now your candle's green if you're trading. And so that could definitely be a situation that would say, forget it. You know, it's a reversal by that time. So if you understand what I'm saying here, you understand the potentialities of the structure you're working with. If you understand the overall range you're working with, expansion to expansion, by the time you work your way up there, it may no longer be a good trade. And it's not. Now what another inexperienced move people would do is they would say, okay, now that the 1 hour is green, they would buy it right here, right? They would say, okay, well, forget it. I missed this. Now I see that the trend has changed, and now I'm going to go long. So they would go long right here and trade against expansion, which you can do. I do have some people that are more experienced. They may feel like, okay, I may get a reversal back up to this level. And they may buy this under expansion right here, your first opportunity, but they understand what they're doing with, because they're trading against a momentum trend on their higher time frame. So they're ready to cut it immediately. It's kind of one of those things like, hey, I'll either catch a big reversal, but if it doesn't behave immediately, forget it. They know the risk. It'll be what it's going to be. But that's what a lot of people that are new, they'll say, okay, well, now I'm at least green and I'm going to buy this. And then all of a sudden it comes down. And now the 1 hour is falling back in line with the directional bias held by the expansion. That's why in the basic strategy, we tell you guys, stick to the basics. On your higher time frame, you're below expansion, you only want to trade within red candles. If you're above expansion, you only want to trade within green candles. Stick to that, because you'll get situations like this if you're trading the 5 into the 1 hour. 1 hour comes below, you hold below expansion right here, game time. And that's where you want to catch. You want to catch those prolonged runs that are backed by the bigger money that's actually moving the market. Okay, so right now, no trade on 5 minute. Hopefully you guys see that. There's nothing, I mean, the only trades that you would have is if you're working with the momentum trades. Your first opportunity would have been right here. You could have sold right here, controlled your risk right above the high. These ones need to get you in the money right away because you're in momentum. The momentum's either going to kick in. If it doesn't, it's probably going into contraction, which goes into expansion, and that means it's going to whip out. So if you're going to rip these rotations short in line, make sure that they either take off immediately. If they don't, cut them. So that was really it for this last sequence. Same thing with this one right here. If you didn't get it above expansion, these are the best opportunities because you can, you get to come back through expansion. You get to go back to that center of gravity. But if you miss those, same thing right here. You had the 5 minute, the hour was clearly under expansion, clearly red. You had this breakout short. You had a rotation here. Boom, smash and grab. Those are fast trades, but like I said, if you're going to take these rotations, make sure you control the risk real tight. And that's the situation that's happening right now as well. Okay. We're getting a little bit over, let's see, it's 11:09. Let me see, I'm gonna jump through the questions and see if there's any more kind of questions that I think would benefit everyone. And I may address a few more here and then we'll probably wrap it up.
Wait, real quick, could you take a look at gold? Because there was a pretty big run up on that. That's always entertaining to look at.
Okay, yeah, let's look at gold. I'm probably just going to do this one on the lower time frames. Okay, gold, what we got going on here? Okay, your 5 minute definitely going up. If you guys, I'm going to give you just and you guys could play around with this and whatever time frames you trade, I always suggest you stick with them. But if you want a little more stable directional bias for your 5 minute, you can switch this to a 4 hour. Because you see in the 4 hour, you had more stability, and in this situation, like for this rip right here, this one was beautiful. Right here, as we came down, ripped the rotation right here, boom, just a huge explosion. But you can see the 4 hour clearly above expansion, and in that, let me see right here, what was the timing on this? This was 1645. 17. 16. Okay, so it was coming out of this turn. Okay, this one maybe I gotta see how this all shaped up right here, but well. Anyway, coming out of this turn, this one turned into a beautiful trade. It went fast though, so I don't know. I wasn't watching this particular one as it happened, but depends on how it shaped up. But in these situations, you will get these situations where you get that rip like that, and the 4 hour will hold a little more stable than the 1 hour. So as long as you're good at looking at the architecture on your lower time frame and you're good at managing your risk based off the expansion and the rotations, then the 1 hour will hold sometimes where the 1 hour or the 4 hour will hold sometimes where the 1 hour can feel like it's turning on you. So sometimes a 4 hour can be a little bit more stable to trade the 5 into the 4 hour if you want to do that. As long as you can manage a 5 minute chart, because I know a 5 minute can get a little fast. Same thing right here. We have a 4 hour coming up. We're coming down here. So in this situation, you look at for a breakout going long. Obviously, the session's about over, so I wouldn't be getting too crazy right now. But there's a good chance this price is at least going to come back to this level right here. But keep in mind, it has ran quite a bit. So if you didn't get anything out of these moves right here, you probably don't want to be going heavy right here, even though it can pay. You want to get in early rather than later. So let's see here. 18. Oh, okay. I was looking at this wrong here. So yeah, this was totally, I was gonna say this didn't make sense here. Okay, so this was 1217 and we're in 1218. I was looking at the wrong time. So 218, I'm sorry. So 218 is 1645 right here. Okay, so that was a candle right here on this rip, and that makes more sense. So right here on the 4 hour, you'd already been traveling away. This was a really good rip. You had a clearly defined trend happening over here. You're above average price. Right here, this aggressive move down, it held off these previous expansion levels. This one right here, rotated back up, long right here. That was beautiful. In this situation, we don't know this is going to happen, right? Nobody knows. But what we do know, we're trading from here to here, there to there. That's our initial get me in the money and give me a decent, strong position and trend. Because we know that it's either going to behave, it's going to come back to here like a rubber band to that center of gravity point on that expansion, or if it dies out, it's probably, we're going to get more information. But we know that there's a high probability we're going to come at least to here and then see what happens. In this case, we blew through that level and put you into the money. So now you're in the money from here to here. When you guys get above, where does that stop loss go? In a situation like this, stop loss goes up to this level, lock in the profit, and you ride it as far as you can ride it. And you will, as long as you stay in trend. And I always say this, if you learn anything from ATS, is finding a directional bias, and I don't care if you're trading moving averages, trade them in trend only. If you do that, you're going to stack the probabilities of in your favor of getting in the money and it being much more forgiving when you do things sloppy. So that's what paid today. That's what's been paying, and that's what always works. Situations like this, even choppy situations like that, you stay in trend above or below expansion in that candle color. That's it. That's the basics of the system. Under expansion, rip the rotation. If you don't feel comfortable ripping the wick, get in on the rotation. Protect yourself either at the low or previous structure. Just depends on how the market works out. See where it makes sense. And you guys will catch moves like this. You're trying to get from here to here, here to here initially. That's it. When you get above, then let the market pay you. Do what makes sense. Look at your higher time frame. See where could this 4 hour be headed, and then work it accordingly. Anyway, let me see if there's one more question here that I can take, and then we'll probably wrap it up. Okay, good question here. So the question is from Tammy, she works a day job. Will you expand on a strategy for longer time frame trading and another training? I will tell you that the what we do transcends time frames. The only difference would be the volume curve of the New York London session. If you're trading on a 5-minute chart, again, you're going to get way more false entries and just markets. They're not false entries; they're markets that are flat. You're going to get way more of that typically in the Asian sessions if you're trading US-based pairs, which most people trade US-based pairs like dollar CAD, Euro USD is the most heavily traded, pound USD. If you are trading those pairs, you want to keep them in the London, New York market sessions. Outside of that, if you're trading a 1 hour and up, then you can get away with just looking for the setup on your higher time frames, like your daily, your weekly, your monthly. Look at those as your directional bias, and you do the exact same things what I'm talking about, whether it's a 5-minute or a 1 hour or a 4 hour or a daily you're entering on. Same principles apply. It just takes longer. It takes longer to pan out. So I'm sure that we'll have more advanced trainings and things in the future that we'll do on that. But guys, the concepts and the principles that I talk about every week are the same. It's the same thing over and over and over and over and over again. It transcends time frames. It works on any market that has reasonable volume, not like penny stocks, things that are just like pump and dumps. Those still the same dynamics at play, but they have no volume most of the time. Anything that has volume swimming around, if it's the Dow, if it's any indexes, the Nasdaq, anything that has volume, any high volume stocks like Tesla, Amazon, stuff that trades frequently and has frequent movements is always going to fall into this flow. It will always work this way. It's not going to change because you're dealing with the structure of the market. Doesn't make it easy. No one ever said that the situation or no one ever said that the system's it's going to be a money printing situation. No trading is that, but what this is trying to do is it's trying to give you, it is giving you the structure of the market, the significant levels to manage your trades around. That's all ATS is. That's what it does. So it's up to you guys to get familiar with it, stay in trend, get good at understanding the trend, be disciplined to the trend, and then work with the structure that ATS has, and work your trades around that. But just start with the basic strategy, work it on any time frame that works with you. The only thing I'll say is if you're working a day job, make sure that you're trading on a higher time frame, something that you can effectively manage. Remember, if you're trading on a 1 hour chart, you really need to be able to look at that chart once every hour or so. If your day job is really hectic, I would trade on 4 hours entry, 4 hour into the weekly or daily into the monthly. I know it's really slow, but your trades, if you're patient, and you can look at a few more pairs. I know we recommend looking at like 1 or 2 pairs, especially if you're trading higher or lower time frames. You can get away with looking at more like 3, 4, 5 pairs, so you're not constantly just waiting for one pair to set up on the daily time frame. But your trades, if you do everything right, your winners will be epic. I mean, they'll be big. You're gonna where someone trading a 5-minute chart is looking at getting 15, 20 pips on average when they're doing everything right. Your average trade's going to be 50, 100, 150 pips because you're going to get used to hanging with those trends much longer than someone trading a short time frame. So there's just because someone's trading higher time frames doesn't mean there's less potential. That you're going to be missing out on a lot. Actually, sometimes it's even better. I'll recommend with traders that if they just are over trading, they cannot keep their hand off the trigger. They're in 20 trades during the session on a 5-minute chart, or even worse, a 1-minute chart. If they're just like rapid fire, I'll tell them like, dude, you got to move to, don't trade anything lower than a 4-hour chart for entry. And they say, well, that's boring. I don't care if it's boring. Trading shouldn't be that fun. If you're having a lot of fun trading, you probably have way too much action going on, way too much. It's about understanding the trends, letting the setups come to you, and then doing your risk accordingly to that, what's appropriate for that setup, and working the architecture that's given to you. We don't control it. We have to conform to that. So anyway. All right, guys, I'm going to wrap it up. If I missed your questions, I apologize. Again, it's hard to kind of get to everything and cover everything that we do. If you do have questions, send them to support@tradeats.com, and we'll be more than happy to help you guys out that way. Other than that, we'll plan on having our next webinar Tuesday at 10 a.m. Pacific Standard Time next week, and hopefully we should have a few more goodies to release to you guys. I know you guys are still hanging in there for those software updates. Believe me, it's main priority. It's just the coding process. The code is done, but we're working on the security features of it. Because if you guys are new, you don't know, we had to deal with some pirating issues. People are trying to rip off what we do, and we want to protect it. Protect the code, especially for our next updates coming up for ATS Assistant. And the next update for the chart map. We want to make sure the code is protected and that it remains special for you guys that are subscribed. We don't want imitators and people throwing stuff all over the internet parading as us. I will tell you guys, no, we do not authorize anyone else to talk about or give out ATS software. Anybody that's posing as Trade ATS or an affiliate, right? We have no affiliates. We don't do any of that. We have no introducing broker relationships. Anything that we say will come from tradeats.com or our webinar or our YouTube channel or we're going to start doing more social media stuff. We really don't pay a lot of attention to Facebook or any of that, but it's going to come through our channel. Anyone else that says that they have our methodology, or they're trying to sell you something saying that it's us, do not do it because it's a scam. Anything from ATS will only come from us. No one else is authorized to give any kind of training or software products that are branded with us. So anyway, just want to make sure that you guys don't get involved in some shady thing or whatever. So want to make sure you guys are okay that way. So anyway, guys, thank you so much for being on. We'll see you guys on the webinar next week. Until then, everyone, just keep doing the basic strategy and stick with it. Stay in trend. The pairs you're trading will trend, and if you stick with it, you will be able to catch moves like what happened in gold. It will happen. So just stick with it, guys. All right, guys, have a great day, evening, afternoon, wherever you are. We'll catch you guys on the next webinar. Thank you.